Good morning, everyone. This is Daily Trading Analysis with the weekly recap for another week of uncertainty, and the focus was on the UK-US agreement on tariffs. In my assessment on the market analysis and segment, I would say this is pretty bearish. Despite this US-UK deal on tariffs, we are still seeing a 10% almost blanket full tariff on all imports. And that's not a success, a good deal in terms of US consumers. So this decidedly negative sentiment is not rooted in a single cause, but rather a confluence of potent headwinds. We are witnessing escalating geopolitical tensions. The most alarming one being the new India-Pakistan military conflict. Don't lose focus on that, because it has been injected as a significant dose of risk aversion into the global markets, directly impacting investors' appetite for US equities. So this is compounding into the persistent and unresolved US-China trade dispute. So marked by aggressive rhetoric and profound uncertainty over tariffs, which cast a long shadow over economic growth. So furthermore, the Federal Reserve has adopted a hawkish stance, with every single official, including Jerome Powell, emphasizing data dependency and signaling no immediate inclination to cut interest rates. So this is a stubbornly sticky inflation, and there are more emerging concerns about the potential for higher unemployment, particularly if trade disputes worsen. In the Federal Reserve's recent communications on Wednesday, we held the interest rates. And basically the central communication, the central understanding of the current trade deals are that the FOMC unanimously decided to keep this rate unchanged at 425 to 450%. The FOMC also signaled its intent to continue reducing its holdings of treasury securities and mortgage-backed securities at the current pace. So we are, again, selling all these Soma holdings. This is interesting, because if the Federal Reserve were to commit on some kind of support, they will stop selling, they will signal or at least have some outlook for decreasing the interest rates, but they are staying in line. They are holding interest rates. They are saying that they will continue selling, reducing its holdings. They are not buying treasury securities. They are not supporting the market either way, because the inflation is super stubborn. This indicates a clear intention to await for greater clarity before changing policy. And this stance offers little help to markets seeing accommodative signals. That's key to understand, because we are seeing how risk aversion, uncertainty, and now the FOMC, the Federal Reserve, is pushing against every single expectations on tariffs agreements. However, Chair Powell acknowledged that the US economy has been in a solid position, with economic activity expanding at a solid pace. He even downplayed some seemingly weak Q1 GDP, attributing them to an unusual swing in trade, and suggesting that if we look through these distortions, the underlying economy remains robust. However, his remarks on inflation were pretty much concerning, stating things like that inflation remains elevated, it's running somewhat above the 2%, and critically, the near-term inflation expectations have moved up. And that's key for the survey respondents that point to tariffs as driving the inflation expectations. So clearly, all these tariffs are really affecting sentiment and are now pushing downward the markets, every single sector on it. Regarding the future path of monetary policy, what can we expect from the Federal Reserve? Well, Chair Powell reiterated that policy is not on a preset path and that the Fed can't confidently say that he knows the appropriate rate path. He allowed for scenarios where rate cuts could be appropriate this year, so we are still on path for that, at least some kind of rate cut this year. But he firmly stated it's not in a situation where we can cut preemptively or be in a hurry. He explicitly declined to update the March projections for rate cuts, advising market participants to wait until June. This cautious, reactive stance underscores the Fed's current posture. Powell acknowledged that the risk of higher unemployment and higher inflation have risen. And you know what this means? Stagflation. These comments from Chair Powell, when viewed against the backdrop of current global and domestic events, significantly amplify the negative market sentiment. His focus on heightened uncertainty and the dual risk of higher inflation and unemployment is deeply concerning for the US markets. Let's move from the FOMC and try to see some economic data. So we've seen the US Q1 preliminary unit labor cost rise to 5.7%. So basically from the 2% pushing almost to 6%. This is a negative jump because it's much higher than the forecasted and previous one, signaling a wage pressure, and this is inflationary. Also, in terms of US April ISM services prices, they jumped to 65 from the already pretty much huge 60. We jumped again to 65. Acceleration in the prices, in the price pressure. This is pretty bad, because if we see everything in conjunction, we can see how every single economic data and every single Fed member is pushing towards stagflation. In terms of some earnings, the recent reporting season has been a mixed bag, that's for sure. There are several high-profile reports that added some kind of anxiety, particularly regarding the impact on trade policy. So, for example, Ford reported the Q1 2025 EPS of 14 cents. They beat the consensus of 4.3. However, the positive surprise in quarterly results was heavily overshadowed by the company's announcement that it estimates a tariff impact of about 1.5 billion in its full year adjusted EBIT, and critically is suspending the full year financial forecast due to the tariff related uncertainty. So they are good, but no one is willing to provide any outlook or forecast on anything because the situation is unbearable. More on that. We have Coinbase. Let's not put that into account because that's crypto, but they were bad. Missed on earnings in everything. Look at this. The forecast was 2.09 and we got less than 0.30 on EPS. Wow. Let's talk about some consumer discretionary. Disney, Uber. We have Walt Disney reporting strong earnings. We know that. But let me tell you again. The confidence on its guidance was pretty good because they raised the full year adjusted EPS to 5.75, but they are also seeing the consumer not willing to spend in terms on subscribers on Disney Plus or in the parks. Uber, strong earnings also. Revenue pushing higher. It also provided the Q2 gross booking guidance, pushing it higher, but the forecast and the outlook was not good. They are below estimates in bookings because people don't want to commit to these kind of things. And finally, AMD. AMD delivered solid numbers. They are solid. And their Q2 revenue guidance also pushed higher. So they boosted somehow the semiconductor sector. But this is not Nvidia, this is AMD. It's good, but all these big businesses are trading with China. And during this weekend, that's going to be a huge, important communication on the US and China discussions. So let's see what happens. Now let's move into the charts because I think we have to really see how price reacted to this. And let me show you the first thing that I would like to mention. That is following up on my previous last week, Saturday's weekly recap. We know that we are here in a pretty much confluence of pressure in the golden pocket from the drop. So I'm expecting some kind of rejection here. I was not so bullish this week. I was expecting, this is a weekly chart by the way, I was expecting this kind of thing, some kind of balance. We are here. I'm still expecting, don't get me wrong, I'm still expecting to go back to some big numbers. I'm expecting 19,000, I'm expecting 18,800, things like that. Why? Because if we check the 1 hour, we've been pushing pivots higher in this market environment. Why? Because retails are still buying this dip. And the big players, the big participants are not trusting this outlook, this tariff uncertainty. And at some point, we will be pressuring going higher, and I think we are going to reject based on lack of big buyers. I'm for sure expecting some kind of deep buying from maybe retails and some participants, but I'm really expecting this trend to break, to look for big sell-side liquidity, and expecting that catalyst that might provide us a good spot for big participants to jump in. Until then, I don't trust this market. Let me tell you why. Let's put the market internals here. This is on the left side, the ES. This is volume. Thursday, big volume, but the rest a nothing burger. In terms of bad decliners, 2 days before the FOMC, and then the FOMC, we somehow maintain that. In the Qs, we have something similar. We pushed on Thursday, but Friday were, kind of adding something, like you can see here. But in terms of market internals, there's nothing surprising giving me signals of there's a strong buying here. So I'm expecting that this volume does not come from big funds, big banks, and big participants. So I'm willing to wait, be patient, until some kind of big signal like this. We have to really wait for that signal in which we say, okay, this is what I like to see. This is something big. This kind of price action is challenging because you can see, let me go to the 15-minute and see how the market behaved during the overnight in the last 2 days. Let me show you something, because I was just seeing this nonsense. Wednesday overnight into Thursday. Look at this. Really move higher. And then we got the pullback and the big push here. Why? On the UK-US deal. But then during the overnight again, yesterday pushing overnight higher, and then these two kind of things, we can see here the expectations and the positive market sentiment on the possible deal on UK. And when it was released here, we can see how the market does not trust this. Just see, try to align the fundamentals with the technicals. And I can see how the market does not trust these deals going forward and does not trust anything with China either. So if we check the 15-minute, remember, this is one of my favorite time frames to see the narrative. The narrative is that we crossed last week high here, and we rejected that, and we are now below. So we had our opportunity to build a bullish breakout, but we didn't commit to that. And that's why I think the big players are not buying this. Big money is not buying these deals. So I'm literally waiting my time to see big moves. The first one I would like to be reclaimed again is this, this is sell side. This sell side, and then at 19,000, we might talk. We will talk at 19,000. And that's my perspective. That's my way of seeing this market. And that's the way I've been most profitable. Waiting for big signals, analyzing everything, and seeing correlations. What kind of correlations we see? We've been seeing a big push on the VIX. So the VIX now is being annihilated. That's a good point. That's good. But dollar is being denied again. People don't trust US. In terms of sectors, what can we see in the financial sector? Yeah, strong earnings, strong push. But this is not tech. We are basically trading the Nasdaq. What the Nasdaq is doing, what technology is doing, is just building on earnings. But this kind of push in this range, without revisiting any lower, I don't trust these guys. That's my gut feeling. And you can see consumer discretionary being really pressured here. We have banks also mixed bag. We have semiconductors with AMD trying to build some positive narrative, but the RSP is also trying to build something. We are more or less trying to build trend, but I would like to wait for that pullback, to wait for that pushback and see if big participants commit to some kind of dip. A second dip will confirm that there's big people expecting and maintaining positions, and that's the best way of trading uncertainty. Waiting for other participants way bigger than us to see if they think that maybe there's upside in this market. So my expectation for next week is that maybe we push for this buy side at 20,500 on any kind of news during the weekend on the China deal. But I think this will be rejected, and we will slowly build towards 19,000. And at 19,000, mark my words, remember what I'm saying. Expect some kind of big push like this, because this push was 11% in 2 hours. This is people pushing. This is big volume. Look at the volume here. And it was obviously before the push. Look at the volume here. So we don't have anything here to build. We don't have anything. There's just a inertia higher. They are squeezing somehow, but I'm waiting for second signal at 19,000 because I don't trust the fundamentals, because I don't trust the way this is moving, and because we are at a key spot in which we may see some kind of big manipulation. That's all, folks. That's my transparent analysis. I'm opening my strategy to you and opening my expectations to you because I trust you may think about this also. So put in the comments down below if you think like me. I would like to hear from you. What do you think this market is doing? Because I don't trust it. I have experience. I've seen this in the past. When people are most excited, they push down. Because the fundamentals are not healthy. And I don't think anyone is going to commit to these kind of things to just a big breakout on all-time highs with this fundamental background. So it is what it is. That's my analysis. Thank you for your time as always. If you found this video useful, please give it a like, subscribe to the channel, support the channel. Thank you for that. Thank you for being with me. If you are new, welcome. And remember that we have to navigate this market somehow. And the 3 skills that I value most is patience, discipline, and risk management. Those are key for your success. Without those, you will be destroyed. Have a nice weekend, rest, enjoy the weekend, and see you on Monday.